Hey everybody, the S&P 500 just hit a record high, so did the Nasdaq, and a lot of the stocks that Tyler and I are following are close to their highs. Not necessarily all-time highs in some cases, but at least 52-week highs. So we're taking a look at some of them. Not every stock that is at its peak, and I'm pretty sure Tyler would agree with me right now. A lot of them look really expensive. I wouldn't put money in a lot of them right now, um, even some that are already in my own portfolio. But there's some that I would. There's some that I think are up for a reason, and still look pretty attractive right now. Tyler's joining me. We're each going to give one of our stocks that are at a peak that we think could go even higher right in the next year or two. Um, Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. You can get the top 10 stocks to buy right now. And it's the best way to support this work we're doing on YouTube. I'll put the link in the description, fool.com/Frankel. Check it out. So, Tyler, before we dive into our stocks, would you characterize your portfolio as at its 52-week high, or because you kind of invest in more obscure and value-seeking companies, are you not there? Are you seeing a lot of really real froth in your portfolio?
Uh, I've got some parts of my portfolio doing incredibly well, and I would say some of the newer positions that I've added to have not been performing as well, which is typically par for the course for me. Because if you're buying like off-priced, mispriced things, there's a decent chance that they could go lower. So I find that's pretty common. But I think over the past year and a half, no, I've got some pretty sizable wins, and yeah, I'm pretty close to a 52-week high.
Yeah, I put my portfolio in three baskets right now. There's the real estate stocks, which still look very cheap. There are my core positions, like like my Berkshire Hathaway, my the core stocks like that. They're doing fine, but they're not at the peaks. They're not at all time records or anything like that. And then I have like my speculative stocks, which those are the ones doing really well right now. Like SoFi recently became one of my largest investments, not because I put that much of my own money into it, because it's quadrupled over the past year. I'm seeing a lot of highs in my portfolio, a lot of cheapness, kind of like you. It's a very mixed bag. But one that I wanted to talk about, and I'll go ahead and go first because I think for the first time since we've been recording these, you're doing the better known stock in this video. So I'm going to go first. I'm going to talk about a company called C. Technically, it's called C Limited. Uh, Ticker symbol is SE. They are a Southeast Asian commerce company. There's three sides to the business. They do digital entertainment or gaming. The Garena platform has some of the biggest, most popular gaming titles in the world. That was the initial part of the business. The second part was the Shopee e-commerce business, which now has grown to a dominant market share in Southeast Asia. Think of it as the Amazon of Southeast Asia, and that's very appropriate. There's a 48% e-commerce market share over there, so really on par with what we have with Amazon in this country. And then there's the financial service business. It used to be called C Money. Now it's just called Money, spelled with two E's at the end. I'm not sure if you pronounce it as money or how they do it, but that's what it's called. And that's the financial services businesses. They loan money. They just launched a buy now pay later service not that long ago. So there's a lot going on with that. So there's three parts of the business, and really all three are looking good. It's not only near a 52-week high. The returns have been absolutely spectacular lately. This stock kind of cratered during the 2022 bear market. It was burning through capital. It lost $1.7 billion in 2022, just to name one time period, and it's really turned things around. The stock reflects that. It was the best performing stock in my portfolio last year. It's up another 65% this year. Between the 2 years, it's up something like 260%. It's been a great performer, but the business has reflected that. It was priced like a money losing company that was growing at a single digit rate. And now it's priced as at a very profitable business that's growing at almost 40% year over year. So that's why the great performance. Revenue was up 38% in the most recent quarter. All three sides of the business are doing great, including that digital gaming business, which up until about a year or two ago was kind of considered a legacy business. the gaming platform was hemorrhaging users in the wake of the pandemic years, and it was just really just bookings declined by 18% in 2022. I mentioned was a bad year. But now, bookings are up 23% year over year in the latest quarter. That business is very that was kind of the profit engine that fueled the other two parts of the business while they were growing. Now the e-commerce business is the biggest of the three. Um, Revenue grew 34% year over year. They're selling a lot more items on the platform, and margins are expanding rapidly. C's gross profit grew by 50% year over year, compared to just a 38% lift in revenue, which means that margins are increasing. On the bottom line, net income was about $80 million in the second quarter last year. It was over $400 million this year. They're well on track to have about $1.5 billion of bottom line profit this year. The stock is pricing that in. It trades for about 45 times forward earnings. That does not seem unreasonable given the progress they've made. If they can keep this momentum up, that could actually be a cheap valuation. But obviously, it doesn't look as attractive as it did a year ago. But I do think C still has some upside potential. All three sides of his business have a lot of growth potential, especially on the e-commerce and fintech sides. I mentioned the fintech side is expanding rapidly. They just rolled out the buy now, pay later lending. There's a bunch of different verticals they're experimenting with. And in a couple years, that business could look a lot different than it does today. But I'm keeping my shares. I think that this one still has a lot of upside ahead of it. Tyler, what are you looking at?
Well, you said familiar, which I think in terms of familiar with a company, maybe not a lot of people know it, but I think anybody who knows engines knows this company. It's called Cummins. Basically, if you know diesel engines, you know the name Cummins or Cummins because they basically make diesel engines for everybody, from basically larger sized passenger pickup trucks, like I think the Dodge Ram has diesel option, going up to small utility sized trucks like F650, F750 sort of range, all the way up into, class one or like 18-wheel trailer trucks, anything owned by PACCAR, Volvo, companies like that make 18-wheelers, tractor trailer trucks. They're most likely using a Cummins engine one way or the other. And here's where if you look at the business, it's an absolute return monster. If you look at, any time over the past decade, its rates of return have been well over 15% for its entire existence. I think out of with the exception of like 1 year where it had to pay some emissions fee violations for some of its passenger vehicles. So outside of like a one-time tax bill or a fine, it's been an absolute return gem. And earnings have grown, or sorry, top line has grown, albeit cyclically, relatively well over the past several years. We're talking a company that went from $19 billion in sales in 2015 to $33 billion over the past 12 quarters. So over, or 12 months, excuse me. So very reasonable growth on the top line. Buys back stock, pays a modest dividend. I think it's almost just about 2% today, grows about 8% annually. And what's the funny thing is even though it is at a 52-week high and an all-time high, which, for a company that started publicly trading in the 60s, an all-time high can look pretty impressive. This is, I think, total returns on Cummins since going public is like 51,000% or something like that. It's pretty spectacular. All those things considered, it actually still only trades for about 19 times forward earnings. So there is a reasonable expectation of valuation here. I think one of the things people might be fearful of is like, oh, aren't the diesel engines fossil fuels? That's not going to work forever, right? When are batteries, when are hydrogen, things like that going to happen? The thing is actually Cummins has been working on that for a very long time, and a very interesting transition method too, because Cummins not only makes diesel, but they also make what are called multi-fuel engines. So you can run diesel and gasoline, or diesel and natural gas at the same time. You can have diesel and electric at the same time. natural gas and hydrogen at the same time. And they've started experimenting with dual and multi fuels as kind of a way to transition from, its core competency of diesel engines to shifting its portfolio to a wider range of like basically powertrains to move products. I think the ultimate goal over time is to get to some sort of multi-fuel product that's going to combine something like hydrogen fuel cells and batteries and take the advantages of all those things, and disadvantages, and kind of mix them into a nice concoction that is going to work for its clients. I mean, I think 36% of its business is PACCAR, and PACCAR is exclusively buys Cummins for a lot of its products. So it has a real inroads with its end clients that, if end clients want hey, can we have a, zero emissions engine, they're like, yeah, we'll figure it out. I think it's one of those things where people will be like, oh, Cummins is going to get destroyed when electric vehicles and hydrogen come to take place. But they are working on those things and working very closely with their clients to build what they want and make the offerings available to everyone. So I think it's a very unique time for this business. Like, despite the all-time highs, it's a reasonable valuation because I think there's a misperception of what the existing business is and what it could be several years down the road with a lot of this investments in R&D. And so with all that in mind, like, even normally I'm not one to jump right into a company at 52-week highs, but 19 times earnings for a very good compounding company with a clear line of sight to a future, that's a pretty reasonable expectation.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.